like to welcome everybody to our first session of our Winter Dairy Team webinars. We're going to have two different speakers today. Diane Shoemaker is going to present first on the dairy margin coverage program and some new changes to that program. And then I will follow up with dairy revenue protection, which is another risk management tool that producers can utilize. So I'll let Diane take it away and share her screen.
Okay. Well, great to be here and see everybody today. So my task today is to talk about the Dairy Margin Coverage Program and also the Supplemental Dairy Margin Coverage Program, which is a new offering with a limited time for folks to take advantage of that. Probably the most important point to make today is that the sign-up period has been extended by 1 week for the dairy margin coverage and supplemental coverage program. So it opened on December 13th and will be open through Friday, February 25th. Farms should sign up at their county office. And a new opportunity that we really need to think seriously about this year is for farms that have grown the supplemental dairy margin coverage opportunity. And that would be applicable for farms that are under 5 million pounds of established production history. And we'll talk a little bit about what that means, that have increased sales since that original production history was established. So let's just touch on a few of the basics about the dairy margin coverage program. Farms that are eligible are farms that are commercially marketing milk. The cost to participate at the very lowest level is simply a $100 administrative fee, and that can be waived for limited resource, beginning, or socially disadvantaged farmers, or also those who have a military veteran status. Important point is that farms that have not previously participated are more than welcome to participate and look into that opportunity now. There are some other eligibility requirements related to income levels and conservation practices on the farm, and the personnel at Farm Service Agency will go over those with folks as they want to learn more about that. But as a quick review, this program was initiated by the 2014 Farm Bill and replaced the former program that set basically floor prices for class 3. And so the emphasis was changed from supporting a price to protecting a margin as we've shifted more toward protecting prices. And the margin that it refers to is the difference between the USDA's announced all milk price, and that's announced every month, and a calculated feed price, which is also announced by USDA each month. And that's supposed to be fairly representative of the feed costs for a cow and her replacement. And it changes every month based on prices of corn, soybeans, and premium alfalfa hay. So the margin between those two prices is what the objective is for this program in terms of protecting that margin. So a farmer who participates would decide upon a coverage level that they wanted to cover that potential margin. And the coverage is purchased for a margin somewhere between $4, which is considered catastrophic, and I really hope we never see a $4 margin, and a $9.50 margin. And that election is made once a year, and then it's set. It is a two-tier system in terms of pricing, the cost of that protection, and the margins that are available. And it's production history of less than or equal to 5 million pounds per year or higher than 5 million pounds. So this program is really focused primarily on smaller and medium-sized farms. That 5 million pound break, you'll see is there's a substantial price break at that less than 5 million pound bracket. And so we were thinking in terms of what size herd that would be. If we had 200 cows and we're shipping 25,000 pounds of milk a year, that would be that 5 million pounds. So it's going to be farms in that 200 to 250 cow range, depending on production. So in this slide, we're looking at the different coverage levels that are available with the dairy margin coverage program. And they range from the $4 down up to the $9.50 level. And in about 2018, these top 3 tiers were added. And that's when this program became much more effective for dairy farmers. And you can see here that here are premiums for tier 1 farms or a tier 1 production. So that's production of less than 5 million pounds. And then here are the premiums for milk above 5 million pounds production history. And just compare the cost per hundredweight for $8 in tier 1 for $8 margin coverage is 10 cents per hundredweight. If we were looking at that or wishing to do that for our production history above 5 million pounds, we just wouldn't do it because it costs $1.81 a hundredweight. So you can see how this is very much set up to be of the most benefit to that first 5 million pounds of production. So herds that have higher than 5 million pounds still qualify. They can cover their first 5 million pounds in this tier 1 at these rates. So that's available to everyone. It's when farms have more than 5 million pounds, they're looking at a higher premium schedule, but they can also make 2 elections. So they can choose one level for their first 5 million pounds, one level of coverage. And then for their second 5 million pounds, they might choose a very low level of coverage, just kind of a just in case. So what I'm sharing with you here is the actual margins that were announced for 2021 and 2020. And when a farm would buy up coverage, this is how it would work. From my example, if a farm bought up coverage for 2021 and they make that decision when they enroll for the year, it's the same coverage for the whole year. Say our farm purchased coverage on their production history for $9.50, the $9.50 margin. Then in January, and here in January of 2021, the margin was announced at $7.14 a hundredweight. The indemnity is simply the difference between the purchased margin coverage and the announced margin. So farms that purchase coverage at the $9.50 level for 2021 in January would have received $2.36 a hundredweight for 1/12 of their production history. So it doesn't matter when your farm actually ships the milk. Maybe they ship more milk earlier in the year and not as much later in the year. It doesn't matter. This program, it takes your production history, divides it by 12, and the indemnity is paid on 1/12 of that each time an indemnity is triggered. What's really been important to farms that did sign up for 2021 is each of these green highlighted cells indicate that at some level of coverage, an indemnity was triggered, depending on what the farm purchased. So that is the first time that we've had that many months in a year trigger an indemnity. In 2020, it was helpful to farms that had purchased coverage at least to the $5 level. They would have received an indemnity in this month. Those that had purchased up to $9.50 coverage would have received indemnities in each of those months. So whether the farm receives an indemnity or not depends on what level of coverage they purchased. But the financial impact has been pretty substantial for Ohio's farms. In 2020, fewer pounds of production history were enrolled. We had 526 farms enrolled for 2020, and for Ohio, over $7.8 million in indemnities were paid. In 2021, we had a stronger enrollment. More milk was enrolled, more farms were enrolled, 747 farms, and through December, it's estimated that $42 million in indemnities were paid to the farmers that purchased coverage in this program. Now, It's very possible farms could enroll and the margins would be very good for a year and no indemnities would be incurred. But one of the more unique aspects of this program is that farms do pay to participate in the program. So I've mentioned production history a couple of times, and I want to just touch on it briefly here, because the next piece or the next opportunity that's available within this program has to do with production history. Because the program was initiated in the 2014 Farm Bill, production history is established by selecting the maximum production for a calendar year of the years 2011, 12, or 13. And now we're in 2022. So there's been ample opportunity for some farms to increase production, whether it was by just getting more milk per cow or by actually adding cows. So that becomes problematic for some farms. So an opportunity that was legislated earlier, just at the very end of 2020, was dollars were provided and the mechanism was set up to allow farms who had increased production the opportunity to increase their production history. So 580 million is available to improve the risk management opportunities, and it's targeted at the small to mid-sized farms. So if a farm already has over 5 million pounds of production history, this really doesn't come into play. But for those who had less than 5 million pounds and have increased it, here's an opportunity to increase their production history, which means they can purchase or buy up coverage for a larger amount of the milk that they produce. So this program is in effect for 21, 22, and 23. It's now 22. So a really key point is if they were enrolled last year, which was 2021, they can apply for supplemental dairy margin coverage, and it was retroactive for that 2021 production. But they need to enroll in this supplemental DMC program before they enroll in the 2022 program, which is currently open now through February 25th. So a couple things about supplemental DMC as we bring this section to a close. If the 2019 milk marketings are greater than the established production history, and for farms that have been enrolled in dairy margin coverage, they'll receive a letter should have received a letter already from their FSA office, and it'll tell them what their current production history is. And if their 2019 marketings is higher, then they will have the opportunity to work with them and increase their production history. Some farms had an opportunity, well, all farms who participated had an opportunity in about 2018 to, if they bought up coverage to $9.50 and committed to that participation for 5 years, then they received a discount on the premium for all of those years. These farms are still eligible to take part in the supplemental dairy margin coverage program, but any new production history that they gain will be subject to full premiums. They don't get the discount on that new production history. And then finally, there's situations where farms have transferred between generations or new farms have been established. And those are cases where there are some opportunities for those farms, but they need to go in and work with their county FSA office to work through the particulars of that situation and see how they can participate in the program. So a quick example of how the supplemental coverage will work. For our example farm, in 2019, milk sold was 4.86 million pounds, and their established production history was 2.5 million pounds. So the difference between those two is about 2.36 million pounds. So 75% of that would be eligible to be their supplemental production history. So have the opportunity to add 1.77 million pounds of supplemental production history that they can purchase coverage on if they want to. So that makes their total production history, their original 2.5, plus the 75% of the difference between their 2019 marketings and their established production history. So their total production history would now be 4.2 million pounds, which can mean have a significant impact on their ability to protect a margin on some of that milk. So when a farm participates, they have their established production history and they can choose to cover 5% of that up to 95% in 5% increments. So in our example, we're going to go for 95% coverage. So the first calculation will be on their established production history. At 95%, they would be covering 2.375 million pounds. And then their supplemental production history, less than 5 million pounds. So the coverage level is the same, one coverage level for all of those. They'd be able to cover 1.681 million pounds of supplemental production history. So their covered pounds have the opportunity to increase substantially from that older established production history. There are tools out there. There's a tool that you can get to from this dairymarkets.org website. You can also get to the same tool from the USDA.gov dairy margin coverage website. This is a quick way for a farm to see what would it cost me at different levels of coverage, different coverage percentages, and different coverage levels. And all the farm has to do is plug in their production history. And when it's under 5 million pounds, you'll only be paying attention to this tier 1 section. And it can show you that if I covered 95% of my 5 million pounds at the 950 coverage level, my premium is going to be $7,125. And then you can see how that premium declines as the coverage purchased also declines. You know, will this come into play this year? We currently have milk prices that are trading pretty high. And right now, as we look at probabilities that are also available on that calculator, it may well not come into play in 2022, but things can change so quickly. So this is, I think, still a very realistic opportunity that farms should consider participating in. Yes, there is a cost to it, but it provides a very effective coverage at that 950 level. If feed prices suddenly go higher than they currently are, milk prices drop, or some combination of those. The sign up again is available through February 25th. I don't anticipate there will be extensions past that time. You do that at your local county office. Farms that have increased their production really need to look at this supplemental coverage opportunity. And a really good opportunity now that has changed over time is a farm can participate in this and can still participate in other risk management opportunities. And Jason will be talking about those next. While we switch screens, I'd be glad to answer any questions or clarify anything.
Great. Thanks, Diane. There is one question there in the chat. When is the indemnities paid? Is it annually or monthly?
That's a really good question. It's really good now in that each indemnity is calculated and paid on a 1-month basis. Now, there is a lag because it takes a month for the all milk price to be announced and some of those other prices to be posted. But if an indemnity is available for January, it will be paid basically in February for that month. So we don't have to wait for a multiple month period. It really does help with more immediate cash flow needs because it's calculated for each month and then it's paid the following month after prices are announced.
Jason Hartshu, the educator in Crawford County. I'm going to be presenting on another dairy risk management program that can be used in conjunction with the dairy margin program, known as dairy revenue protection. This program is ran through RMA, where the one Diane talked about, dairy margin coverage, you utilize your local FSA office. We'll go through the different steps and parts of dairy revenue protection and kind of help you see how you can utilize it, kind of some things about how it's performed and how it's made up here. So the first thing I kind of want to look at, though, as we get into this, is a little bit of history on milk pricing. As we look across this graph, I have normalized it in the gray bars, adjusted those for inflation. They're back adjusted to 1983, and then the average milk price is the actual milk price in that year in red as an average. So as you look back, the trend over time continues to be, we start back here with the inflation adjusted, we're actually just over $15, and that price continues kind of on this downward trend and kind of has leveled off and bumped up and down here in about the last 20 years since 2000. Inflation adjusted, though, hanging out over $10. But if we're talking real dollars, we've been running from about a $15 milk price all the way up to a high of a little over $20. To look at the last 10 years, when those different milk prices happened, in September of 2014, we saw a all milk price high of $25.70 per hundredweight. And then May of 2020, which was actually in Diane's slides a little bit ago about the dairy margin coverage program, we saw the lowest milk price from the last 10 years of $13.60 at that farm gate price. Thinking about Diane's program, she talked about over those 10 years, we saw a margin low of $2.50 per hundredweight and a margin high of $15 per hundredweight. So when we think about that, that goes back to the dairy margin coverage program and those margins, where the dairy revenue protection program, on the other hand, is actually looking, instead of at farm gate prices or all milk price, it's actually looking at the milk classes that are traded on the futures and options market, Chicago Mercantile Exchange. We're going to focus in on class 3 and class 4. There's also what's known as a component average, which I'll explain a little bit more later, but that uses a selected percent of fat and protein that you select, and then uses some contracts off the Chicago Mercantile Exchange to create that component coverage. The Dairy Revenue Protection Program can somewhat be thought of as a put option. So what we are doing with this program is we're not locking in a milk price, but we are setting a floor under our milk price so that it can't go any lower than that, to hopefully at least lock in break even or lock in a positive revenue. So if we look over the past 20 years, as you kind of dive into this program, understanding history a little bit can make you a little bit more confident in your marketing decisions. So over the past 20 years, class 3 milk close average. So that is when the futures market closed for each month over the past 20 years, averaged out to $15.29. The contract highs, so that is if you average every one of those contracts over the last 20 years, and when that contract was highest, averages out actually exactly $2 higher at $17.29. While the contract high average actually doesn't come high enough to match Ohio's cost of production average, that extra $2 can be very beneficial to us as producers, especially when you look at the futures market 20-year low average of whatever the lowest value of each one of those contracts was over the last 20 years at $13.21. Nobody's ever going to be the best marketer in the world and always hit the highs. But if we can get a little bit better than average, it can help improve our operation. Or the Dairy Revenue Protection Program utilizes a 3-quarter average, though, where futures are traded on a monthly basis. The DRP, Dairy Revenue Protection Program, utilizes this 3 months for a quarter average. Looking at the purchase windows, so you have to purchase your contract at least 15 days before the quarter begins. 45% of the time, all 3 months had their highest trade futures numbers value during that purchase window when we could have purchased a DRP contract. Only 20% of the time did none of those quarters or none of those 3 months in the quarter have their high during the purchase window. And typically when that happened, that no months in the quarter had their high during the purchase window, was on rallies. If we look at what milk price has done over the last month, well, two to 3 months, we've been in a really strong rally of futures 2022. During this time, there's a pretty good chance that quarter one will not have its highs during when we could have purchased a quarter one contract. But there were some options and times when we at least could have probably locked in a profit for quarter one. Look at class 4 milk. Class 4 average close on the market was $14.76. That average high when all the contracts were at their highest for each month, $16.63. Average low, $13.09. If you've been following markets, you're going to see that right now, class 4 is actually our market driver. And if you attend next week, you'll learn a little bit more about what is going on in the dairy markets from Dr. Chris Wolf, who's going to be doing a market outlook with us. Class 4, 56% of the time, all 3 quarters had their high during that purchase window. And about 22% of the time, no quarter had its high during the purchase window. And again, for class 4, those came when there was no quarters during that purchase window during those large market rallies. But again, what goes up must come down. So there's some good opportunities to lock in, if you look back at those futures markets, some good profits before the market crashed again, looking at that high. Dairy Revenue Protection Program is designed to minimize the impact of those price declines by locking in. You're putting a floor under your milk prices offered through RMA, or the Risk Management Agency, utilizes those prices from the futures market to set a revenue. And also it covers a decline in milk production from your pooled region, and it is sold by quarter. So when I say it covers by pooled region, is that if for some reason there is a decline in your entire pooled region in milk production, even if price was high, there's potential it could trigger a payment because of that production decline. It will not cover a decline on your own farm though, only. So some different decisions you have to make. I've kind of laid them out as a 7-step process and have some slides that go with each one of those to explain them a little bit better. So decision 1 is who to use as your DRP insurance provider. It's offered through RMA. So the majority of crop insurance providers, if you currently have crop insurance, can provide you with the DRP product, but not all of them are set up and extremely knowledgeable about it. You may have to work with a different agent than what you currently do. Also, depending what agency you go with, some of them have some nice coverage quote tools and daily emails. I find the daily emails to be very nice. Every evening they send out an email with the parameters I put in to give me a quote on what that dairy revenue protection coverage is. And you basically have to check every night because it's only available when we get to the when to purchase part, only available while the market is closed. The next major decision, once you know who to purchase it from, is to start looking at levels of coverage to purchase. Percent coverage of futures quotes prices is what we're looking at here. The higher the coverage, so when we're up here at 95% of that futures quote, has a little bit lower premium subsidy. So only 44% of the premium is covered at that time. When you look at those different coverage percentages, if you've worked with put options before, 95% is in the money. When you get down to 80% coverage, you're getting out of the money because you are at that lower coverage level, but they are also cheaper. So if you're looking to just set a floor at your cost of production during a good rally, you could utilize that 80% coverage, and with a 55% premium subsidy, it can be a much cheaper contract. So I'm an example here of Q2 2022. This is a contract that could have been purchased last night. So it could have been purchased the evening of February 10th. At the time, Q4, when we look across, the blue is the trigger price. So 95% coverage. We have just about a $23 trigger price. And then when we look at how much that would have cost, it's not quite 40 cents. It's about 38 cents per hundredweight that would have cost us to set a floor trigger price of right at just fuzz under $23. On the other hand, that cost us 41 cents. If we come down here and we did 80% coverage, which is right down here, That actually would have only cost us 2 cents to cover that Q2 production, but it also has a trigger price of $19.50. So if you're just looking to protect that cost of production and your cost of production is under $19.50, you can protect that for 2 cents a hundredweight. Pretty reasonable protection from a catastrophic market collapse. And you can do in 5% increments in between. 85 and 90% are also options there. The next decision you have to make, to me, is the amount of production to cover. So this is how much of that quarter's production would you like to cover? You can do policies to fit any herd size. That's the really nice part about this program is it can work for the largest herd in Ohio or the smallest herd. Unlike if you go out on the futures and options market where there are contract sizes and you have to buy in those contract blocks, that is not part of this program. Our smallest herds or our largest herds can participate. Milk can only be covered once. That's an important thing to remember, but you can do multiple contracts of different types per quarter and at different coverage levels as they become available. So there's contracts in class 3, class 4, and component coverage. It can be very useful to use all 3 of those because they are each traded separately and could each change and trigger a payment at separate times to help protect your herd. And when you look at Ohio's milk pooling, we sell both class 3, class 4 milk, and we sell class 1 milk. And class 1 is a formula utilizing class 3 and class 4 pricing. And we sell on a component blend price. So if you're selling really high component milk, as we'll see in this example in a minute, that coverage by component can be very beneficial to your operation to cover that higher value milk. There are some production obligations though. If you choose a class 3 or class 4 contract, you have to produce at least 85% of the milk you cover. So if for some reason you don't produce that 85% of the milk you covered, there's not a huge penalty. It just reduces the amount of coverage that you have. You can't get paid for more milk if you don't produce that 85% of what you contracted. Component coverage, you have to produce a little bit more. You need 90% of the fat and protein pounds. So when you do fat and protein, while you utilize a percentage, that component percentage, say 3.1 protein, 3.75 fat, that is calculated into pounds of fat and protein, and that's how the contracts are written. The next decision to make is when to purchase, what quarter of coverage to purchase, and there's a marketing window. So these contracts have to be purchased between 4 p.m. and 10 a.m. Eastern time. And sales also close 15 days prior to the start of the quarter. So typically, if you are subscribed to an email service that sends you those market updates for DRP, about 4:30 to 5 o'clock, you get that update, and you need a good working relationship then with your agent because you're going to be asking them to work after hours on getting your policy submitted. Yes, they could get up early in the morning if their day starts at 8 and get it done between 8 and 10 a.m. But if they had something else scheduled that morning, they may not be able to do that. So you need that good relationship so they will work with you after hours. It's available for up to 5 quarters at a time. Premiums are generally more expensive for those further out quarters. The types of coverage I've kind of touched on, you have class 3 coverage, class 4 coverage, and then that component blend, fat and protein, where you get to build your own based on what components your herd actually produces. You can select the coverage combination that best matches your herds in those current market conditions. You can look at our Federal Order 33 or whatever federal order you're in, and what percent of that milk comes from class 3, 4, class 1, and kind of build it around that if you wish to give you the closest protection for your own marketing and milk check. Look here, we're going to compare class 3 to component blend. There's some differences there. So this is the exact same time frame of purchasing each contract. They both had different trigger prices. We'll touch on protection factor a little bit more here in a bit, but we'll keep protection factor for now as 1.5. It's kind of a multiplier of that protection or a basis for your own farm. So when we look here, if we use 5,000 hundredweights covered, the trigger price for our class 3 milk was $16.25 on the board. After the sale, $16.15 was the class 3 milk price. So class 3 was under $16.25, so it triggered a 10-cent payment. We have that production factor, which actually takes that 10 cents times 1.5. The producer premium or cost of that contract was $3,050. So our producer payment, we didn't actually cover with the class 3. Our total cost, we had to pay RMA $2,300. That's not always the case. Class 3 is not always better than component blend. Just in this instance, it was, especially when we're working with a high fat herd here, 4.55 and a protein of 3.55, gave us a revenue trigger at $19.80. The actual component price came in at $18.09, so a little over $1.40 of coverage there that we're looking at. Had a $4,000 producer premium, so our producer premium was more expensive, but we had a producer payment of $8,000 and $8,775. So while this time it worked out with component blend having a much better producer protection, that's not always the case. And it can be a very justifiable reason for using all 3, class 3, class 4, and component blend in your marketing plan. Protection factor. For that example, I used 1.5, and you get to choose that protection factor. So when you think of protection factors, you can purchase them in 500th increments. It doesn't change that trigger price. Whatever the trigger price is, it is. Your trigger price will always be 95% or 80, 85, 90% of that futures market number that you purchased. But once it is triggered, the protection factor is a multiplier. And it does increase the premium. It can be thought of though somewhat as basis. So how much does your milk price tend to run above whatever contract type you're using, whether that's class 3, class 4, or component? How much does your own milk price run above, and use that as your protection factor? Because when we look at protection factor here in this example, this is a different contract, but we have a revenue trigger at $16.53. We use a protection factor of 1. And 1605 is our class 3 milk price. So we have not quite a 50-cent revenue protection there that gets triggered. For producer premium of $2,700. So then our producer payment is $2,100 in the positive. Where if we would have used a protection factor of 1.5, our same trigger of $16.53, just that bigger protection factor, does cost us more. Our producer premium goes from $2,700 up to $4,000, but our producer payment or revenue positive of the program was $3,200 by utilizing the markets and using a bigger protection factor. When we look at protection factor, pulling Q1 2021 had a trigger of $18.90. Q1 closed at, or $15.80. Sorry about that. Q1 closed at $15.98. So there wouldn't have been a indemnity triggered for Q1 of 2021 based on that trigger purchase of $18.50. We come over and we look at this graph at the different protection factors, though. Basically, this protection factor goes up, revenue guarantee goes up, but so does net premium cost. Net premium cost for this example goes from about 38 cents here at protection factor 1 to about 58 cents at protection factor 1.5. Look a little bit more at the protection here, where you have a Q1 2021 an example and a Q3 2021 example on this graph. So red, dark red, and light red are Q1 2021. The straight line running across the light red is that close. It closed at $15.89 for that average. Whenever our premium is above, we are positive because our trigger here is below. So we had a positive payout here from any purchase from about July through November, where we could have actually had improved our revenue. The same thing happened in Q3. Actually, Q3 comes back up out here. Again, gives you another purchase window, but there was a small purchase window here in November where we could have purchased Q3 coverage that was above that final payment and would have triggered a payout. Just showing here that everything moves differently. I have Q1 and Q3 again for 2021 on this graph, and we have class 1, class 4, and component coverage to show how they move differently. So we have the blue line here, which is Q1 class 3, And then we have the orange line down here, which is Q1 class 4. You can see they both went down, but then we had Q3 come back up where Q4 stayed down here. And the light blue is Q1 component pricing. And you can see it moves around a lot more. And you see the same thing in Q3 where they don't move in unison. Each one of those 3 contracts moves differently. Here, it looks very busy on your screen, I'm sure, maybe even a little bit confusing to you. Looking at different quarters, different contracts, but then also what the difference in the premium is. When I look at the program, a lot of times I like to look at trigger price and then what my premium indemnity is, because that's what the program is going to cost me. So I'm going to have to pay that back no matter what. And is that high enough for my cost of production after I subtract that premium? Of course, the premium moves together, but you can see that there is some difference here in the width of the spread. If we look down here at the dark green, which is class 4 milk, Q1, we look at that contract, it costs more to purchase that contract in July than what it did to purchase in November. And that is very common. The further away you are from that contract maturing, the more it is going to cost, the higher the premiums are going to be. Next decision to make after you understand the types of contracts that are available is when to pull the trigger on purchasing a contract. Farm cost of production is incredibly important. Understanding what your farm basis is. Farm price compared to the various CME board traded prices. Then some different strategies to think about. The first one is break even. That one's critical. Anytime you can lock in a price that is breaking even, set that floor so you're avoiding losses. You can generally live to farm another day. Above break even. That is the next type of contract that is highly favorable because that is locking in those profits. The more profit you make, the more you can obviously invest back in your operation or save up for retirement or whatever your dreams and goals are. And then the other one is below break even. Some people will ask, why would you want to go below break even? If I am at the next quarter, so if I was looking at Q2 for 2022, and my cost of production was higher than what I could purchase a contract for, and I had concerns that milk price was going to plummet, I could purchase a contract at below break even because it's going to protect me from even greater losses. So to look here a little bit more at some examples of comparing the futures markets to the DRP program. This is for February 11th today. Actually, it's off of last night's close. And we have Q2 of 2022 through Q2 of 2023, which are the DRP contracts that are currently available. As we look at milk price, it does have a downward trend in the futures market. Now, we will need to listen to Dr. Chris Wolf next week, see what he foresees as the forecast on out, because milk price does tend in a rally to trade highest in the close-up months. But as we look, class 4 milk here, class 4 futures is leading the charge. And then we can look at coverage. So I mentioned that it's a 3-month average. So that 3-month average, April, May, June is Q2. We have a futures range of $22 to $22.60, gives us a DRP contract average of $22.80 with that trigger price. So if it fell below this price, DRP would make a payment of $21.17. Same thing when we come over here to class 4 milk. A DRP average of $24.18 and a trigger of $22.97. So we go down through, we can look at these different contract options to think about if any of them are right for our operation. And you get down here, you can see that the months are trading fairly tightly right now. We go down to Q1 of 2023. We have $19.40 to $20.10, about a 70-cent trading range with that class 3 DRP of 1974 average or a trigger at $18.75. Now, these are going to have some different prices to them. So look at the cost of what those DRP contracts are going to compared to going out in the futures and options market. We'll take a look at this. One thing to keep in mind is with DRP contracts, they can't be sold or rolled, meaning that if for some reason I purchased a DRP contract and my trigger price was $18.70, and I'm looking at Q2, and now I could go out and purchase a trigger of $23. If I already covered all of my milk, I can't change that, which is somewhat of a unfortunate part of the program. But at the same time, it's understandable because we can't cover more milk than what we produce. So when we look, we're going to look on December 2nd. We pull Q2 class 4 price. So at that time, I purchased a DRP contract. It's going to cost me 33 cents. And the class 4 futures market for Q2 of 2022 is $19.36. Today, or really last night, April class 4 futures with April expiration. Looking at puts, that put option is currently worth 2 cents. If I had done futures and options, I could have sold my put that I purchased for 2 cents. It's going to be very expensive because that put would have cost us over 60 cents. If we look at an in the money put option right now, which is $24.50, today that April $24.50 put is going to cost $1.11. Compare that to what DRP is going to cost. 95% coverage put option, or the DRP, is 41 cents. And that compares to that 95% coverage. So 24.50 is that in the money option. 95% of that would be a 75-cent option. So we save about 35 cents using the DRP program over the futures and options program with that milk price floor. So to summarize this, as we kind of come to a close and open it up to questions, premiums are going to be due at the end of the insured quarter. So after the quarter is over, it's almost a month later, you'll find out what your payments may be, and also you will get the bill for your premiums. RMA will notify you of a probable loss. At that time, you have to provide them with your milk check summaries so they know how much milk you produced, to go back and make sure you produced 85% of fluid milk for those class 3-4 contracts that you purchased, or 90% of the components that you covered. Each quarter is going to be protected separately. Protection factor is this increase. It increases coverage dollars, but it does not increase that trigger price. Whatever the trigger price is, which is 95% of that futures, is what the trigger price stays. Each coverage type moves independently, so you may want to manage your risk with multiple coverage options. Are there any questions for Diane or I? And also remember to tune in next Friday, where we will have Dr. Chris Wolf with us. He's an economist from Cornell University and is going to be providing a dairy market update, talking about current conditions in dairy supply, demand, to help you better understand where markets may be headed, which will let you better market your milk, utilizing the DRP program, and then potentially understand if you should be in the dairy margin coverage program.
I would mention one thing, Jason. You talked about knowing cost of production being very important for program participation, and I absolutely agree with that. But when we look at cost of production, you need to be aware of whether it's the cost of production for the enterprise, or the basically kind of what I think of as the cash flow cost of production, where it also covers family living needs, principal payments, and so forth. So knowing what those costs are on a per hundredweight basis to make sure that we're not only having some dollars to reinvest, but also to just make sure we're getting ourselves paid too.
Correct. Very good point, Diane. And both of those really are important numbers when you start looking at when to set that floor and when to feel happy and not have buyer's remorse about the floors you set under your milk price. I'm sure there's some people today that have some buyer's remorse on their Q1 and Q2 2022 coverage through DRP. But hopefully they set those at levels that covered that cost of production as it became available. And the nice thing about the DRP program or put options over, if you had actually gone out and purchased a true futures contract on the Chicago Board of Trade, is you still get to participate in that upwards market potential. In that, as milk price potentially looks like it could average out at like $22 to $24 maybe for the quarter. You have that indemnity payment. If we think back to what I showed of about 34 cents, but you get to also then participate in everything from 1950 up to wherever it lands, and all it costs you is 34 cents. Where if you had actually went out and purchased a futures contract, you would have locked in that 1950 not only as the floor but also as the ceiling, and had to make a whole bunch of margin calls as milk price went up.
Right. And we recognize that it's easy for us to sit and say, here's how this works. And, investing the time to set up a plan for your farm and then making those decisions. It's not as simple as just listening to a presentation may lead you to believe.